We have a colleague, Janita Wall, who's the founder of the Second Saturday program, and she has the bumper sticker that says, "A man is not a financial plan."
Yep.
And I always tell her, I joke with her, well, you can say that. As a man, I would get in trouble if I said that too loudly, but she can say that. And there's some truth in that. Your spouse is not your financial plan, whether it's a man or a woman.
That could rise to number 2 on my list of favorite bumper stickers. Number 1 is reserved for use an accordion, go to jail.
I remember you quoting that one. My favorite one is, quick, hire a teenager while they still know everything.
Welcome to the 3 Wise Men of Divorce, Money, Psych, and Law podcast. Sit down with the California divorce experts, financial divorce consultant Mark Hill, marriage and family therapist Pete Russos, and attorney Shawn Weber for a frank and casual conversation about divorce, separation, co-parenting, and the difficult decisions real people like you face during these tough times. We know that if you are looking at divorce or separation, it can be scary and overwhelming. With combined experience of over 60 years of divorce and conflict management, we are here for you and look forward to helping by sharing our unique ideas, thoughts, and perspectives on divorce, separation, and co-parenting.
So, Mark and Shawn, when the news about Silicon Valley Bank and Signature Bank hit, what kinds of concerns did it raise for you? If I can frame this as a 2-part question, for couples and families that are in a dissolution process now, currently, and the implications on the financial settlement discussions, et cetera, but then also families who are post-divorce, an MSA has been signed, it's been filed with a court, maybe there's a couple of years out, and then some kind of a financial crisis or issue results in a significant change of circumstance. I'm really curious how you guys navigate or think about those.
And can I offer a friendly amendment to your questioning?
Please, yeah.
The first question to answer, because some of our public may not be clear on this. What in the heck happened with Silicon Valley Bank and the other bank? Was there another one in New York?
Signature Bank.
Signature Bank. What happened? Why did it happen? And how does that affect people's money?
And I can address that.
And you can address that.
Yep.
So maybe you should. And then let's talk about how that affects a divorce.
Mm-hmm.
Mm-hmm.
So what do you think, Mark?
Yeah. Well, what happened? Here's what happened. The bank had taken deposits and put it in long-dated treasuries. So government bonds that matured 10 to 30 years out.
Mm-hmm.
As the interest rates went up, the value of those bonds declined. And so as those bond values went down, their net equity in the bank declined. And so that places them in jeopardy. And then the issue for this bank was that they had money in long-dated treasuries at a time when interest rates that went up the most in 40 years, in a short period of time. And there's an inverse relationship between interest rates and the value of your bonds. With those longer-dated bonds, if they hold them to maturity, they get the face amount back. But if you try and sell it early, and interest rates have gone up, so new bonds are more attractive than the one that you own. They're paying 5% as opposed to 2%. Well, guess what? In order to sell your bond, the price needs to adjust so that the current yield is the same as new bonds are offering. That's essentially how it works. Mm-hmm. And they went long treasuries and didn't hedge against them. The other thing that went wrong was that bank did not have a risk manager.
Mm.
They didn't have somebody whose job it was to basically every day look at their portfolio and establish the risk, or to monitor the risk at least. And that's going to be something I think that comes out at some point. I think the other thing is that bank was very concentrated in one industry. So in the tech industry. So they didn't have a diverse portfolio of loans and deposits. It was all tied up in that industry, and that industry has struggled and valuations have come down.
Mm.
And so where you assume that the company is going to be worth something based upon a valuation that existed 2 years ago, and you lend against that valuation, and then suddenly they can't sell at those prices they were selling at a year or so back, then suddenly your loans are not secure. So what do? Do you call it? Do you reduce the line of credit? Because most of these companies are not profitable, certainly not in an early stage. So they need to have funding to run operations until they can reach profitability. Mm-hmm. So that's kind of what my understanding of what happened with Silicon Valley.
And so far, it sounds like nobody's been hurt yet.
Right.
The bank, obviously, but
well, the shareholders
are going to get their money.
Yes, and I don't understand that.
You don't understand why they're not getting hurt?
Yeah, because usually, you're insured up to $250,000. That's the FDIC. Now, the bank shareholders should certainly be hurt.
Well, it sounds like there are going to be bailouts.
Well, how does
even though they're saying it's not a bailout?
Do they bail out the shareholders, or do the shareholders lose? Go back to the banking crisis, guys. None of those big banks, well, a couple did fail, but all the too big to fail banks were basically bailed out. Yes, your Washington Mutuals went away, but your Citigroup didn't, and your Wells Fargo didn't, and they were in as bad a shape as many of the other banks that failed, but they were systematically too large. So one of the things you think, if you want to put your money somewhere, it's got to be with an institution that is too big to fail, where the banking system simply cannot afford them to go.
Right. And this is different from the previous. I've heard people say, "Oh, it's just like the one in 2009." It's not.
No, it's not
anywhere close.
Well, it's different because that was based upon an asset class being destroyed.
Right.
That was the CMOs, the collateralized mortgage obligations, that were basically, they took them and they broke them up into all these different tranches, and they made it so complex nobody really knew what they owned, and that whole class of investments went down when real estate prices dropped. This is different. This is not an asset class blow up. It's an individual bank. Now, it's two individual banks, and of course we can't forget the crypto house here in La Jolla that just went bad too. So there are a lot of, as I say, this is the end of the beginning. The immediate crisis has been fixed. Now we need to see who the counterparties are. Who was owed money by Silicon Valley Bank, who may be in difficulty because they can't pay them.
The end of the beginning. Leave it to you to wax Churchillian.
I can do that.
Yeah. But, okay, so I'm a person out there, and I'm worried about my divorce.
Yeah.
And I got money in the bank. What am I thinking about in regards to, well, number one, the money that I have, and number two, decisions that I'm making in my divorce?
Well, money gets very emotional, and people get very scared around their money. I'm reminded of the Pritzi's Honor line from the movie. No, you don't understand. The Pritzi's love their money more than they love their children, and they really love their children. And that's how people are with money. It's true. I mean, it really is that people become very emotionally involved with their money. In a way, it's a part of how we keep score. I get that. But emotional reactions with money when stuff like this happens can often be not the correct thing to do. I think the key to it is do you have more than $250,000 in deposits in any bank? Number one. If you do, I think it's by entity. So if you have 250,000 in your name, 250,000 in your trust, and your wife has 250,000 in her name, I think you're okay. But if you have
all of those are insured.
Yes, by FDIC, Federal Deposit Insurance Corporation. By the way, that's fine if the whole banking system doesn't go down. There's no money if the whole system goes down, which is why it takes me back to what I was saying before about the big four banks that are too big to fail, that would be propped up no matter what, because if they go, there's no money to pay the depositors even up to the 250 limit. So the first thing is evaluate where you are. The second thing you should do is take a look at where you're banking. If you're with a bank that has a conservative reputation, doesn't do a lot of venture funding and that kind of stuff, you're probably fine. They're probably not going to be even a potential counterparty. But you see what's happened with the regional bank stocks over the last 3 or 4 days. It just tells you how the concern of contagion can create a contagion. Just the worries. Oh my gosh, they're regionals too. They're about the same size. Oh, I don't know what they do. Sell. That's how this tends to go. And of course, the selling, my God, have you seen what ABC Bank has done? It's down. So, oh, well, sell our shares too. And that continues to drive the price lower. And that's an emotional reaction, which is not necessarily crazy. But, we used to joke about how people, when they buy a stock near the top, they love it. And then when it gets to the bottom, they hate it and sell it. Because that's, how almost emotionally we're built. And I think what we're dealing with in this situation is unlikely to cause the same degree. But as I said before, we don't really know what the ramifications will be yet. I think one other thing to be concerned about is what kind of investments do you hold? If you hold a lot of early stage tech type investments, those companies may have trouble getting funding now. And so if you are on that pre-IPO point, in other words, there's no active market for you to sell these securities into. Company is still privately held. It's never gone public. It doesn't trade on the exchange. Those are the kind of companies where you think you may have value, and who knows what the value is today after what has blown up over the last few weeks. It's certainly lower than it was 6 months ago.
So what does it this kind of event, if you will, how does it impact cases that you guys are already in process with?
Right now, I mean, there's not a huge impact because people aren't getting hurt yet. My only frame of reference, I go back to 2009 during that financial crisis, and we had people that were going through their divorce, and they were making assumptions based on how the world was before 2009. And then the world changed.
Yeah.
And the assumptions were no longer valid. And things that they thought were worth a lot of money were worth nothing. We had situations where people bought the other person out of a house because they thought it was of value, and they gave money to the other spouse to buy them out of the house, and then the divorce is over, and then their house is now upside down and worth nothing, and they lost it all.
Yeah.
And
the other thing,
you can't do anything about that after the divorce is over.
The other thing that has happened too is that if people were working for a high-tech company whose stock price goes down significantly, and they received options during the year and did not sell, they then have a tax bill based upon the exercise price. And if the stock prices collapse, they got no money even to pay the taxes. So you remember that one, Shawn? Yeah.
Oh yeah. So we had that case. So diversify your portfolio even during the divorce, and then especially after the divorce, right?
Yeah, and remember, and whenever you have a tax bill, put the money in a risk-free account that will be there next April. Put enough money to cover your tax bill in a risk-free account. Don't make the assumption that the stock will keep going up and you won't have to sell as much and then pay more tax in order to pay your tax. That's how people think. Oh, I don't want to. I managed money for people for years, and how many times have I heard that some person say, "Oh, I don't want to pay the tax, so I don't want to sell." Well, 2 years later, they would have loved to have paid the tax.
Yeah.
You know?
Right.
Mm-hmm.
Yeah.
Well, so I mean, basic financial principles matter whether you're getting divorced or not, right?
Yeah, absolutely. Yeah.
So what is that? I heard somebody tell me, maybe it was you, Mark, I don't remember, but you concentrate to get rich and you diversify to stay rich.
I'm not sure I said that, but I should have.
Oh, okay. Well, but I mean, you maybe you made a lot of money in the tech industry. Maybe that's part of your job. You have these options, or maybe you're the spouse of that person and you're thinking, hey, yeah, so-and-so.com is doing really well. And I just want to keep all of that. But I mean, diversification is an important principle, whether you're splitting the egg or not, right?
And we have this massive recency bias. We are experts as human recency. So whatever happened in the recent past is going to be extended into the, mystic distant future. We're just going to be whatever happened then. And that's not how it works. People tend to take the approach that if I can just keep doing what's been working recently, I will be fine. But that's just not what history tells us. The other thing that's really important to consider is what stage of life are you at? If you're 28 and you have a high-tech job and you lose all your assets, well, you've got time to recover. If you're in your 50s or 60s and this happens, you don't have time to recover. So that's why financial planners always suggest an increasingly I won't say conservative, because we still have to, as we found out in recent months here, outdo inflation, keep our purchasing power, but at least being aware of what your risks are and where you are in your life cycle and what's appropriate at this stage of the.
Well, don't you think, Mark, like diversification in the financial settlement is also important? Like if you just aim for one type of asset, you're running some risk there, right?
We have that all the time where
I just want the real estate, right?
I just want the house, and that's well, it's been my biggest and best investment. I've heard that so many times.
Right.
Well, great. If you bought a house in 1929, you made your first profit in the United States in 1953. So again, okay, recency bias, right? And so real estate may prove not to be as good an investment in the future because of a higher interest rate environment. You would buy any house in the world, guys, for $1,000 down and $1,000 a month. You wouldn't care if it was $100 million asking price, right? So the cost of carrying the debt is the most critical thing. And I think that we're going to see much less activity in real property because so many people have locked in low interest rates. And why would you move? If you got an interest rate of 3 or 4% and current rates are 7%, why would you do that? Why would you sell and have to rebuy and increase your cost of carry by, doubling your interest costs?
Well, one thing I want to caution people on too is we've had, I remember after 2009, people wanting to redo their marital settlement agreement, redo their judgment.
Yep.
Because it was a good deal when they thought about it and they signed on the dotted line, but then the crisis happened. Now it's no longer a good deal. That's baked. That's baked in. You're not going to be able to set that aside unless you can show that there was fraud in the inducement or something like that. But just because the market went crappy for you and you lost money on what you fought so hard to keep in your settlement, you're not going to be able to unwind that. But there's a difference from property settlement, and then what happens when the income dries up. Or
talk
if
about
there's
that
inflation. That's been something I've been hearing a lot lately. Is I want to get a cost of living adjustment because there's so much inflation. And you can modify support after the fact, at least in California, if you can show a substantial change of circumstances.
The scenario that I'm wondering about, Shawn, is let's say somebody working in the tech industry loses their job.
Yeah.
Loses their income, or income goes dramatically down.
Right.
Can you talk about when at what point is a circumstance like that um, addressed in court or in a legal process?
So a person loses their job, that's a material change of circumstances, right? They don't have the income anymore to provide the support, or they don't have the cash flow anymore and they need more support. So that can be something that gets addressed. And the court can modify support based on the amounts of incomes that are available.
And is there typically a timeline for that? For example, I'm thinking, does somebody have to be out of work for a number of months before their case would typically be heard, for example? Or
No. So anytime there's a change of circumstances, as long as it's material, the court wants it to be material.
And define material, Shawn.
Well, I was just going to say, it's kind of a subjective question. I've heard judges say it should be at least a 15% difference. But there's no bright line in the code. The rule is just, it needs to be a material change of circumstances, something that would materially affect your decision making regarding this particular amount of money that you might be receiving or paying. Something that does happen where a lot of the supported spouses get upset about this is they have increases in things cost more now, especially given the inflation, but the income of the supporting spouse hasn't increased or hasn't increased as quickly as the rate of inflation. You're not going to get a modification that's going to be commensurate with the rate of inflation. Because, we're not going to starve the support payer just because things cost you more. Things cost him more too, or her more too.
And is child support handled the same as spousal?
No.
Okay.
So child support is just a strict formula. At least in California, it's different in every jurisdiction, but in California and most jurisdictions, there's a formula. It's garbage in, garbage out. You put the income factors in, and then some other factors like what's the amount of health insurance you might be paying, or what's your tax situation, and that kind of thing. And then what's the timeshare with the kids, and then the computer spits out a number, and the court can't deviate from that number by 1 penny.
Do change of circumstances impact, or how do change of circumstances impact?
Say we had a child support order. And the divorce is over, so the child support order currently exists, and then somebody lost a job, or somebody got sick, or somebody got a new job and increased their income. That's a change of circumstances. We're going to go and we're going to put new inputs into the computer, and it'll spit a number out, and then we've got child support. Spousal support's a little more nebulous than that, at least in California. In California, it's controlled by Family Code Section 4320. And there's this list of factors. I always tell my clients, if you have insomnia, just read Family Code Section 4320. It'll help. But it's like factors A through H. And it's things like, what was the marital standard of living? What are the current expenses? What are the current incomes? What are the earning capacities? Did somebody commit domestic violence during the marriage? Did somebody give up career so they could take care of kids and the other one could build their career? It goes on and on.
And my favorite one is anything else the court thinks is relevant.
Anything else the court thinks matters, right?
That's my favorite one.
And none of these factors give any guidance to what the number should be. So for that reason, you could videotape the same spousal support argument and show it to 5 different judges and get 5 different answers. But it is, when there is a change of circumstances on spousal support, like increased income, things like that can happen, but it doesn't tend to go above what the marital standard of living was. So say support payer, say she's earning X dollars when the divorce happens and she pays X dollars of support, and then she gets income increases because gets a new job and hits the jackpot. The court is not going to award the other party an increase of spousal support that takes them beyond what the marital standard of living was. Which then begs the question, well, what was the marital standard of living? How do you even know? So there's a lot of moving parts there. So when you have a financial crisis like this, like what happened in 2009, where not only did it affect assets like real estate, but it also affected income for folks. Like either maybe you were in the real estate industry and absolutely clobbered you, or maybe you lost your job just because it was a recession. there can be modifications to support in those circumstances.
I'm struck as we're talking by what I assume is an important difference between a litigation process for divorce and a non-adversarial process such as collaborative or mediation, or I think about the cases that the two of you work together on, and I've got to imagine that the level of discernment, but also the complexity with which you think about the person's circumstance or the circumstances of the people in these cases, the kind of advice that you give is way more thorough than somebody would experience in a litigation process.
That is absolutely true.
Mm.
I've done this. When you're doing litigation cases, you're usually negotiating on the steps of the courthouse.
Mm-hmm.
And you're not spending time thinking about, well, what will happen if there's a financial downturn, and what will happen here, and what was the, the subtleties that are really important to good financial advising are not available. Plus, you don't have a Mark Hill with you.
Yeah.
It's just two attorneys who I wouldn't trust an attorney with my money at all any farther than I could throw him, because we went to law school so we wouldn't have to do math, most of us.
Yep.
Uh-huh.
So you don't have a financial planner there with you while you're negotiating your divorce in a litigated context. In most cases, I think attorneys are wise if they do utilize someone like that.
But they don't, Shawn.
But they don't.
They use accountants, and it's for rent. They use accountants, and accountants. Think of the term we put with accountants: forensic. It's looking backwards. Look what planners do. Look at the situation and project forward.
There's no planning.
So there's no planning in most divorces. It's like, here you are, here's your settlement check. Good luck.
Mm-hmm. Mm-hmm.
Yeah, that's absolutely true. I mean, and what you can do in a mediation or in a collaborative case, Mark, you and I've done this so many times. It's forward looking. We're looking at interests as opposed to what went down. When you're at the court, it's always looking to the past.
Mm-hmm.
But when you're negotiating in an interest-based negotiation, like what you would have in a mediated case or a collaborative practice case, you're always looking forward. And so having a person like a Mark Hill, a financial planner who can help people kind of see, this is, I've even seen people like you, Mark, provide reporting that, like, this is what your financial picture might look like with settlement proposal A versus settlement proposal B. Or just giving people the reassurance that you're not going to be under a bridge. I promise you, this settlement that you're getting, you're going to be fine.
Yeah, and there's a fine line here, but there's a fine line here between looking at a settlement and giving the person information about what their cash flow is going to look like. But I'm always reluctant to take on the role of the post-divorce financial planner, having been a financial neutral.
Right. You won't take that role.
So I won't do that. So I'm not going to do the projections and the planning. And as you said before, like the program, it's garbage in, garbage out.
Mark, I think it would be really important for you that's an ethical boundary. And if you would just talk about why you think that that's such an important boundary.
Well, it's because we hold ourselves out to be available to the couple to come back in the event that there is some financial issue arising from the divorce. So they don't have to go back into court. If there is a change of circumstances, like we've been talking about, they can come back to us. Now, if I had taken on the role of the wealth manager and financial planner for one of the couple, I have a conflict now. And candidly, even if I'm working for both of them, what if one has 5 times as much money as the other? Would there not be a fear on the side of the one that doesn't have as much money that, I have a benefit. I got to keep her happy because she's got all the money, So again, can't do it,
I can't tell you how many times, Mark, I get a case where the people have their financial advisor who's going to help advise them through their divorce. And I always say, well, that's dangerous.
Well, it's dangerous to the advisor too.
Correct.
I mean, there's an ethical and possibly a career danger in that. But more importantly, there's a risk that you will upset one of the couple during the case and potentially lose them both.
Mhm.
You could lose them both. But the other thing, the danger to the couple is, this person knows your financial circumstances, but this person may not be experienced in divorce work.
Oh, when I did my CFP, my Certified Financial Planner designation back in the 90s, we had 4 big fat books. And I counted, there were 260 odd pages in those books. I went through every page of that thing and found 5 pages that talked about divorce. Okay. I'm no kidding. It's like it's an aside in a couple of areas.
By the way,
they were beautiful pages, I imagine. 5 beautiful pages.
I don't recall them being that beautiful, but perhaps they were, and my memory's just suspect. But that just tells you how little focus, even for somebody who's a CFP. And a lot of financial advisors are not even CFPs, which, by the way, means they're not fiduciaries. So be aware of that,
Or they'll say, well, I'm my tax guy. My CPA will help me with this. And I'm like, well, and then I'll have a conversation with the CPA, and I'm really surprised at how little about the Internal Revenue Code they understand when it comes to divorce issues.
Exactly.
Like whether you can file jointly or separately or head of household, when you can do that, what happens when people get divorced, who can claim the kids. I'm really shocked sometimes at how much the CPAs don't know, and I end up having to educate them about how the Internal Revenue Code works when people are going through a divorce. So it is important, if you're going to use a financial person in your divorce, to get somebody that has experience in divorce work. And I tend to look for the CDFAs, the Certified Divorce Financial Analyst.
But I think they should have either a CPA or a CFP
I was just going to say, that's my bias. I want to see that secondary.
Well, I have both designations, and one is far more rigorous than the other. Let's put it that way.
CFP is more rigorous than CDFA.
Oh, yes. Oh, my Lord, yes.
Well, and you guys have an ethical board that keeps you in line too, right?
Well, yes, and they've developed
CDFA, maybe not so much.
Well, they've recently developed it, so it has.
Okay.
I mean, it's getting better, certainly, but the CDFA is probably 1/10 of the effort involved in getting a CFP.
It's a nice add-on to a person that already has a financial designation.
Exactly.
As opposed to this is going to make your career. It would be an add-on to a career you already have.
I would agree on that. Yeah.
So let me ask you both this. What is the case that wouldn't benefit by having Mark or someone like Mark involved? Is there any that wouldn't benefit?
Well, we do have the occasional case that has no assets and only debts. Even they can help. They can get help. So it's very few. I think that the sometimes there's a very, very simple situation, and the clients kind of know what they want to do, and there's certainly no need to pay a financial person in that case. But if you're a normal Southern California, which is who we tend to work with, couple who have a house, couple of 401ks, and kids to put through college, all of those factors, I think, create real stress when it comes to divorce. And having a neutral person who can, validate them or say, well, you may not be, in fact, in quite as bad a shape as you think, because I think you can make this work. And also giving guidance about what's affordable. I mean, people tend to go, well, I, lived in a 6,000 square foot house, so I'm going to rent something that's the same. Well, let me help you with the numbers here, sir. And just you can do what you want, but I'm concerned where you're going to be in 3 years when
I agree with you, Mark. I there are many cases that I do that you never hear about because they're so simple it would be silly. And though there are folks out there that's an appropriate response. I mean, as a mediator, I'm just happy to help them just get through this. There's not a lot to go through. But when you get beyond a certain net worth or a certain place in your life, and you're like most of us, you got a house, you got a retirement,
right?
Maybe you have deferred compensation,
Stock options.
then you're just silly not to go ahead and make the investment in a certified divorce financialist who's also a CFP or a CPA.
And there's another thing too, is that where there's been a total division of labor in the marriage, where, say the wife did all the finances, paid the bills, and she did everything, and the husband's just clueless. Even though there may not be a large amount of assets, it might be prudent to have me spend some time with the husband and get him up to speed so he can literally be a participant and feel confident of the decisions he's making.
Yeah.
Well, and divorce can have long-term financial implications.
Oh, yeah.
So having a person that can help you kind of think about the long-term financial implications of your decisions.
Actually, Shawn, can I ask you this? I imagine it's very, very rare that it doesn't have long-term financial implications.
I can't imagine a case where it wouldn't, unless there's they had no money to begin with and there was nothing to divide.
So that it's not that it can have, it's that it absolutely will have. It sounds like what you're saying.
Yeah. I mean, if you have any kind of nest egg, you're gonna take a hit, right?
Yeah.
And so, and there's a lot of, we were talking about emotions, Pete. I mean, this as well as or better than we do. When people think about their money, they get very emotional about it. They make decisions based on irrational constructs as opposed to actual rational thought. If that wasn't the case, then every marketer would be out of business.
Right.
Because people do make decisions based on fears, pain, greed, wants.
And just think, every time someone buys a stock, assuming it will go up, they're buying it from somebody who sold it because they're assuming it's going to go down.
Well, and I think if we, circle kind of back, we're getting back to where we started. So in a way that we're talking about, so what is the impact on a divorce process when something is happening externally, if you will, that is really creating valid reasons for increased anxiety and fear, and how better served people are in the kind of process that the two of you offer, because of the level of support that's there, the level of analysis that's there, the level of understanding that's there, but also the level of patience that's there.
I think that's true.
Yeah. And just the first thing you do is you gather the data.
Yeah.
I mean, and that's usually not the first thing that people think about. I should be doing something. It's dereliction of duty if I don't act. Okay. And sometimes there's a fear by the person running the money in the marriage. Oh my gosh, if I don't do something and it goes to zero, am I in trouble? Yeah. So first of all, gather the data. Number two, have a conversation with your spouse. This has happened. This is where we're at. What do you want to do? Because sometimes we can say, well, I'm comfortable with it. I want to keep my half. Well, I want to sell my half. We can address that during the divorce process so that both people are protected. Right, Shawn?
Yes. And please, for the love of God, don't make major changes until we're done.
Yes, certainly not unilaterally.
Certainly not unilaterally.
Don't go and buy a $10 million business in the middle of your divorce.
Oh, yeah, we've seen that.
Yes, we have.
and it doesn't go well.
And take a very large small business loan to accomplish it, which now we wonder who's really liable for, since we didn't agree upon a date of separation.
Now I feel like I have to edit our podcast because that may be too obvious.
I don't think so. I'm amalgamating two cases there in different
okay,
numbers.
Good. Yeah. Well, I mean, but it does happen commonly, actually.
Yeah.
That people, like you were saying, the person's afraid they have to do something. So they want to sell things. They want to buy things because
it's all from the right motivation. But again, it can have a very bad impact. When COVID hit, I had a panicked call from a couple, and she owned a large amount of Exxon stock that he had some interest in. And it collapsed. Remember, after COVID, no one was driving. So oil price, remember the oil price went negative on the futures market at one point?
Yeah, I remember that.
Remember that?
Yeah.
And now we're what?
You're going to pay me to store your oil.
Yes, exactly. We can't find a tanker to take it, was the reality. So again, he was panicking. He wanted to sell. And they were in a divorce process where they couldn't get their lawyers to even meet because they were too busy. And I don't know what happened with them. I talked to them a little, just chatted with them. It was a free consultation. But I often wonder what happened to that couple and what happened with that huge position in Exxon that she held.
Well, let's say they had a huge position of Exxon and then they didn't do a major change and they kept that money in Exxon. How would they be doing today?
They would be golden.
Right? So,
yes.
Don't panic, folks. Just kind of calm down.
But if, you had shares in Netscape, back in 1999,
Ooh.
Whoever sold their half of the shares is feeling, probably is still living on that money, whereas the other person's probably still working.
You just gave me a chill, Mark.
Well, I bring it up because nobody knows.
Yeah.
Nobody knows. And we have had a period of extremely strong equity markets that have gone on since 1981. 42 years, guys, and secular bull markets, and that's what we call a secular bull, where you have cyclical bears during it, like 2008, like now, like 2001. But the trend is this way. It's up, with dips. And then you get to a period from like the late 20s into the 50s where it was like down and back up to where you were, down and back up to where you were, where you really did not have any growth in markets for years. Remember, I talked about recency bias. Everyone assumes that stocks will go higher because economies grow. Well, it's a nice thesis, and it's certainly been true in recent years. But once everybody knows what's going to happen, it doesn't happen.
I just sat down with a guy from a brokerage house that shall go unnamed, and he did exactly that, Mark. He showed me the history of the stock market for the last 20 years. What about the last 100 years?
Yeah.
What about that?
Yep. The charts go back. Tell him that the charts go back to the 1920s. You'd like to see those.
I'd like to see those, please. Yeah. But okay, so when you're in a divorce, one thing we can't tell you is that we have some crystal ball, and we're going to be able to tell you exactly what's going to happen in the market or with your particular asset, and whether that's an awesome idea or not necessarily. But what we can tell you is you got to think about it, you've got to plan, and it's good to diversify. That's what I'm hearing. So that if a crisis comes your way, whether you're in a divorce or not, you're not going to get completely killed.
And get an education during the divorce. If you are what we term the unmoneyed spouse, learn. Time to learn, to find out what you've got. Then you can perhaps understand what your risks are in your portfolio, because we're talking about a bank failure. But, stock meltdowns are much more common than bank failures are. And so markets come and markets go, and you just want to be aware what your risk level is.
And along with that, your spouse, though successful during your marriage, may not be magical. They're just a person, and things can go badly all of a sudden and really quick.
And how many times have we examined a portfolio where one spouse is telling you, oh, he's a genius, he's really good. Right. And then you look at it and you go, well,
yeah, he was lucky.
He would have been better off in money market for the last 20 years.
Yeah, you're looking at it from the planner standpoint. You're like, yeah, this guy, he thinks he's really good, and she thinks he's really good, but he's not so much. We have a colleague, Janita Wall, who's the founder of the Second Saturday program, and she has the bumper sticker that says, "A man is not a financial plan." And I always tell her, I joke with her, well, you can say that. As a man, I would get in trouble if I said that too loudly, but she can say that, and there's some truth in that. Your spouse is not your financial plan, whether it's a man or a woman.
That could rise to number 2 on my list of favorite bumper stickers. Number one is reserved for use an accordion, go to jail.
I remember you quoting that one. My
Yes.
favorite one is quick, hire a teenager while they still know everything.
Well, gentlemen, it seems we've done it again.
We have.
Yeah. And you know what? There's people out there that are actually listening to this crap.
Oh, I love it. Yeah.
Well, they were until you called it crap.
Oh, yeah, that's true. This award-winning podcast.
Thank you very much.
It ought to be award-winning. So if you want to nominate us for something, folks, please do.
We'd be delighted to be nominated.
Yes.
Yeah, we talked to some people the other day, Mark, that actually listen to us on a regular basis. It kind of it was nice to hear some feedback. So people are out there listening to us. We're glad to know that folks listen to this podcast and get
also
something out of it.
Let's throw this out again. If there's a topic you'd like us to talk about,
please
let us know. Send us an email, contact us. We will guarantee to address it.
Mm-hmm.
Well, next time we do this, we're going to talk about what the artificial intelligence told us we should talk about.
Yes, we will.
I put in, for those out there listening, I put into the chat, what is it, Chat GPT?
Yeah.
What should the three wise men of divorce talk about? And by George, it gave me a really good topic.
Mm-hmm.
So we'll see. We'll see if you agree.
Very good.
All right.
So Shawn, if somebody is thinking about divorce or wanting to explore dissolution processes, how do they get in touch with you?
They should go to my website, WeberDisputeResolution.com. That's Weber with one B, spelled like the grill, dispute like we had a fight, resolution like we solved it.com. And we will match you with a mediator to resolve your dispute no matter what it is. We'll get you through it.
And Mark, for people who have questions about the financial implications of divorce, financial processes, you've got so many initials after your name. There's a whole bunch of things that you do. How do people find you?
Go to my website, which is the company is Pacific Divorce Management, and my website is pacdivorce.com, PACDIVORCE. We have a contact form, we have phone numbers, and we have a fair amount of information on there about what we do. And Peter, if there's an emotional that should come up during the divorce,
also my website. My website, peterroussos.com, PETERROUSSOS.com.
Okay. Well, we'll catch you guys next time.
Great.
Thanks for listening to another episode of the Three Wise Men of Divorce: Money, Psych, and Law. If you like what you heard, be sure to subscribe, leave us a review, and share with others who may be in a similar place. Until next time, stay safe, healthy, and focused on a positive, bright future. This podcast is for informational purposes only. Every family law case is unique, so no legal, financial, or mental health advice is intended during this podcast. If you need help with your specific situation, feel free to schedule a time to speak with one of us for a personal consultation.